Hello, welcome back. Here is Ali Talabi. Today we are going to talk about the second lesson from the second module. As I promised, today we are going to talk about financial intermediaries. So the argument here is that unlike 500 years ago, 700 years ago, in which people they could communicate easily with each other and they can get money from specific sources directly. Nowadays, it's kind of difficult to get direct financing. What I mean by that? The argument here is that, let's say we have a company here. So that's a company A, which needs money. And also on the other hand, we have investors. So which they have money. So this company A is looking for the money, needs money. And investors actually, they have the money, they have extra funds, and they're looking for some sources or some actually opportunities to invest on. So one way, which is the direct investment, is just giving money to the companies or people who need the money, and in exchange, they will get their principal, the original money plus the return or the interest. However, it's not practical anymore, or it's very challenging because we have many of these companies, we have many of these investors. So the issue of trust, the issue of distance, how distant these are, the issue of some legal issues. So it brought us to the point that we need some intermediaries, such as banks, which can help us to actually mediate this flow of funds or money between those people or companies who need money and those investors who have extra and going to provide. So this model has now changed, and now we have this intermediary firm in between. So just let's call that intermediary firm. So usually investors are giving their money to these intermediaries, and these intermediaries, such as the bank, they provide their money to the company. And for sure, in exchange, we will see that they provide some evidence, some document, some supporting document to that intermediary, and in exchange, also they provide some sort of certificate to investors. Now, we have various forms of these intermediaries. In this lesson, I'm going to focus specifically on three of them. Let's first start with mutual funds, which is one of the most common form of intermediaries, especially in the financial market, especially in the context of investment. So the idea here is simple. Let's say you have $5,000 and you're going to invest in the stock market. The stock market is going up, just you want to make sure that you are getting some return or some benefits from investing in the stock market. With this $5,000, you cannot buy many shares. Maybe you are able to buy one or two different companies in your portfolio, and you believe that having more shares can help you just to diversify your portfolio. You can minimize your risk. With $5,000, you are not able to diversify your portfolio. Maybe you can buy 10 shares of one company. So what you do instead, you can use or you can refer to some mutual funds. What they do, they actually pool, they integrate the funds from different sources. So they have millions of dollars, which enable them to diversify their portfolio, invest in different industries, invest in different stocks, which is actually helping you to reduce or minimize your risk. So this is how actually mutual funds they work. So they pool the money and they actually invest in different companies. Now, when you have $5,000, you go and buy a few shares of this mutual fund. It looks like actually you're investing in the whole portfolio, or you're getting a part of that portfolio. So you're enjoying that diversification of the stock market. You are not buying the whole market or that 30, 50 stocks. However, instead, you're buying a part of that portfolio which belongs to this mutual fund company, so you can enjoy this diversification and you will actually get the benefits of that. And for sure, these mutual funds are managed by a manager who is expert in the field, the investment field. What are the advantages? Diversification, I already mentioned that. Professional management, so the person who is in charge, he knows what's doing, he knows about the market, he knows about the stock. And the third one, which is very important, especially for the retail investors, is the initial investment. You don't need to have hundreds thousand dollars. Most of them you can start with $2,000, $3,000 minimum investment. So it's good for you as well. So with this minimum amount, you can go and enjoy the many benefits you will get from these mutual funds. However, it's not risk-free. There are some disadvantages of these mutual funds. One of the major ones is the cost. Those are not free. Usually they charge you for their cost. And it's called expense ratio. So different mutual funds, they charge you for different expenses. Some of them they charge you 1%, some of them 1.5%, some of them more based on the total investment. And these fees are regardless of the profit they're making. So it doesn't matter how much they make, and in some cases how much they lose, they charge you that minimum and the cost. So maybe say, Ali, it's not fair. I haven't made anything. Still, I need to pay. Okay, that's your choice. If the market is good, usually the performance is good. When the market is down, you might lose your money. So you should consider this as well. Very similar to the investment on stocks, you will see that the issue of double taxation also exists here. So for the contribution, which actually we call the distribution, for the distribution you receive from mutual funds over time, such as the dividends or the capital gains, still you need to pay taxes. Yes, you're right. The company, the corporation is already paid the taxes. For example, if in your portfolio, in the mutual funds portfolio, you have Microsoft, IBM, or some other companies, they already paid their taxes. But still, as the owner of that mutual fund, as the owner of the shares of the mutual fund, still you need to pay taxes for the capital gains or dividends you receive. Do you like it? Most probably not, but that's how it works. Just before moving on and talking about different type of investment companies or financial intermediaries, remember that the value of these mutual funds is usually based on what we call NAV or net asset value. Maybe say, Ali, what is net asset value? Net asset value is actually the total assets minus total liabilities of these mutual funds. So whatever is left, it's called net asset value. So the net asset values are usually calculated based on share. So let me give you an example how it's calculated. Let's assume the total assets of a mutual fund, for example, is $1,000. Just make it very simple. And the total liabilities is $200. And this specific mutual fund has 100 shares. So 100 shares, that's the number of shares issued by this mutual fund. So from here, you can calculate the NAV, which is $800 in total. However, as I mentioned, the NAV is usually calculated based on shares. So you can say NAV per share is $800 divided by number of shares, which is 100. Then it gives you $8 per share. That's how the value of the mutual fund is calculated. And remember, sometimes maybe you hear about the open-end fund, closed-end fund. Just to make it clear, open-end fund, it means they can sell additional shares to investors. So they can buy and sell their own shares. However, when you're talking about the closed-end funds, they are not able to issue additional shares. The already existing shares of mutual funds are traded among the investors. So most of the funds are open-end funds, but for sure you will see some of the funds as closed-end funds. The second form of financial intermediaries, which is kind of relevant to our arguments, are ETFs. Exchange traded funds, or ETFs, are another form of financial intermediaries, very common investment and very common in capital markets. What they do, ETFs, actually ETFs, they try to mimic or actually copy the performance of a specific segment of the market. So they follow a specific index or they follow a specific segment of the market. Sometimes they are called index funds because, as I mentioned, they are following a specific index or a specific segment. Let's say you are interested to invest in IT sector of the market. But for sure, it's very challenging to go and buy all the shares in the IT sector of the market. Buying like IBM, Google, Microsoft, you need lots of money. But what they do, they have all those stocks in their portfolio. So if that sector or segment is going up, you will enjoy the benefits of that rise. So that's the whole argument. So that's very good. So one of the major advantages of ETFs is their cost. Their cost is much lower than mutual funds and hedge funds. So if you are, I would say, investor looking for your first type of investment, you want just to minimize your risk, maybe ETFs are a very good choice for you because, as I mentioned, first of all, you can follow a specific sector or the whole index like S&P 500. And second of all, their cost and the expense ratio is very low, somewhere between 0.3 to 0.8. So I would say it's less than 1% the expense ratio, which is much less than the mutual funds. And the last form of financial intermediaries, which I'm going to discuss, is regarding hedge funds. Now, hedge funds are not maybe very appropriate for retail investors. I'm going to mention in a second why. The format, the structure is very similar to mutual funds. They collect money from different investors. But the problem here is they actually are much more volatile, more riskier than other type of funds. Why? Because actually they are looking at diverse selection of investment. They look at derivatives, options, for futures. They're looking for short selling, and they look for more complicated ways of investment. So they have more options in terms of investment, but as I mentioned, the risk is higher. Another feature of hedge fund is the initial investment. Usually, they ask for much higher initial investment from investors. Sometimes they even ask for minimum $100,000. So maybe for retail investors, 100 grand, it's not easy to start. So that's why actually that's a kind of barrier just to make sure those investors who have enough money and they're looking for higher, riskier type of investment, they consider these hedge funds. So you should be careful when you are going to choose this. On the other hand, the expense ratio of these hedge funds are much higher than the mutual funds and ETFs. So hedge funds are, I would say, the most expensive in terms of the fund. Sometimes even they ask for 2% expense ratio, and on the top of that, for any profit or gain, they're asking for high portion, sometimes up to 20% of the profit they get from you. So just to wrap up, we noticed that we have different type of funds, different type of intermediaries, and I mentioned ETFs are cheapest in terms of the expense ratio. Hedge funds are kind of most expensive, and let's call them the most luxury type of funds you can find. Depending on your needs, you should be able to find the appropriate funds. So here is the second lesson. Next lesson, Well, next lecture actually will be the wrap up of the second module. I will come back with some hints and questions, and we'll just finish this module. Thank you very much. Here is Ali Talibi. Talk to you soon. Take care. Have a wonderful day.